Family can sometimes be a great support, but sometimes it can be a massive hindrance.
A lot of the time, that investment property doesn't really cost them money out of their own pocket.
It's really important for my business that I have that strategic relationship. Welcome to VSBN podcast. I'm Chuck from Proactive Property Management, and here today I have some amazing special guests. On the far side, we've got Hamish from One Haven Property Group, and to my right here, I've got Jonathan from Mortgage Choice Williamstown. And we are going to talk today about how three total different businesses can collaborate together and serve the same client. All right, let's get right into it, boys. Thank you so much for coming today.
Great to be here, mate.
Good.
Thank you, Charl. Thank you for having me.
Thank you, Hamish. Good. All right, we're going to start with a quick overview of, I think just so that we can, with the listeners, we can just give a brief description of what each of our businesses do, core values, mission statements, and things like that. Hamish, we'll start with you.
Yeah, perfect. So I am the head of property at One Haven and a partner with another guy called Gareth Robinson. So One Haven's essentially, put it simply, is a one-stop shop for property. So we do off-the-plan investments, which is just house and land, townhouses and apartments all around Australia. We do established real estate, which is buyers advocacy and vendor advocacy. Do a lot of advisory for clients to create wealth via property. Do a lot of SMSF, so self-managed super fund acquisition. So essentially design the business to be a one-stop shop that a client can come through the door and we can give holistic advice to make sure we're putting them down the right path, wherever that may be around Australia, into property investment.
Cool. Mr. Lee?
Yep, so part of Mortgage Choice. So we've got a couple of Mortgage Choice franchises. We've got one in Williamstown, Chatswood up in Sydney, also in Greensborough. Really specialise in helping create wealth through property for our clients. I'm a big believer of people with the great Australian dream, where they buy their house, work hard to pay it off. 10 years later, they sell it. They buy a bigger house, work hard to pay that off, another 30-year loan term. Yep. 10 years after that, they get another loan for 30 years to cash out for that renovation they've always wanted to do, and they end up kicking the can down the road and end up with 60 years of a home loan, want to retire along the way, still have debt on their house, and got no real means of paying that debt down. So I think that we can utilise the equity that they've got, use that to leverage to purchase investment property for the specific purpose of reducing the debt later on in life.
Perfect. Thanks, boys. Proactive is a property-focused business. I've been in the industry for 17 years. When I sort of joined at the age of 28, I really found that there was a fundamental flaw in the way real estate agencies were run. They were, 95% of them were sales-led agencies, and then they had a property management department. So Proactive sort of grew and built out of that philosophy, where I really just wanted to empower property management and property managers to really just be their own entity within the real estate game. So we've been going now for the last 6 years, and really just giving clients a property focused service and working with alliance partners like yourselves, and just being able to give, again, I think the key word here is that one stop shop, to all our clients, and just giving them that service, bumping shoulders, and not being driven by a sales-led department. And look, to be honest with you, when it comes to sales, tough gig, very tough gig. Hamish, that one of so. But I think property management and sales are two totally different skill sets. And I think being a property management focused entity really helps the client get the information they need, and then referring them on to the experts like yourselves. So that's sort of a bit about us in a nutshell. I think we'll go forward here in terms of, Hamish, tell us a little bit more sort of on the journey on how you sort of go ahead, get the client and go through that process, and how you would possibly sort of integrate with someone like myself or Jonathan.
Yeah, absolutely. So 95% of our business is referral based. So we work with a lot of financial planners, accountants, mortgage brokers all around Australia. So I would say we work with close to 100 in and around. And so they'll have a lot of clients obviously looking to invest. They could be the rawest of raw, just have no idea what to do and where do we go and where do we start this whole journey, to very experienced investors that already own a portfolio, earn a lot of money, doctors, lawyers. You can imagine we have a pretty broad range of clients that come through the door. So every bit of advice is tailored. Not every client could be the same. Obviously, you can't treat that doctor compared to the first home buyer coming through the door. So the most important thing, though, is to understand what their goals are and where they want to get to, and make sure we align with that with any property purchase we make. So And what I mean by that is, in examples, you might have someone that's 26, 27 comes through the door, they're going to buy their first home to live in, but ultimately it is still an investment for them because it won't be the only home they ever live in or buy for the rest of their life. So making sure they're aware of where they want to get to. So a lot of meetings, a lot of due diligence with clients to make sure we understand their goals and then get to the point where we just work through the strategy, then work to the point of acquisition, whatever that may be. An established property and off the plan, house and land, whatever that may be, aligned with obviously what we've discussed with the client. So, yeah, it's obviously it's a long process, but it's something we do very proudly, and I love the clients we have, and obviously working with brokers and financial planners and obviously property management. We have everything covered in-house and external partners to make sure that the clients feel like they're looked after from start to finish.
Yeah, so when you say everything in-house, is it a collaboration? Like you said, national brands, you deal with a lot of mortgage brokers and all of that type of stuff, so you would have quite a lot of external companies that sort of you do a partnership with?
Absolutely. Yeah, absolutely. So look, I said, we work very close with all our partners that refer the clients. It's not just a tick and flick with the referrers that come through to us. We all work on the same page, and they're our best partners. The most involved brokers and planners and accountants are usually our best brokers that we work with because we're all on the same page to help the client of where they want to get to. And obviously there's external partners like conveyancers, building inspectors, property management, as you're aware, so to make sure that we can help clients all the way through. As an example, if we have a client living in Queensland that's buying in Victoria, we're not expecting to buy a property then go fend for themselves and find their own building inspector and and conveyancer and property manager. We want to support them through to the finish to have a great experience and ultimately come back and buy again and build that portfolio.
So the idea of One Haven is to sort of have have that collective, have one client and then try and manage the whole process through that.
Absolutely. Yeah, they're the best clients. I think one of our clients now, the other day, is up to his 6th property.
Yep.
So, obviously one of our favourites. So, you get great pride out of that, out of building someone's wealth and to that point. But even the ones at the other end where you see a client 10 times, the ones that are very, very nervous people and, without our help, they would have never bought a property.
Yeah.
Like they'd still be stuck and doing what they're doing now without our push and guidance to get where they get to. So there's always enjoyment and great pride, I suppose, you take out of any purchase you get for a client. But you're always going to have that with a broad range of people that we work with.
Yeah, perfect. Jono, now tell us from the loan perspective. I think very similarly, clients coming through, wanting to get into that market, not knowing how to do it. And I know your dream and your passion is investments and getting people to break out of that, Australian dream. How would the journey go for you typically?
Yeah, so the big one is that nobody wakes up in the morning and goes, I want to be a landlord or I want to have an investment property. But what we're able to do is, a lot of people, they've got equity in their property, then they come to us for a cheaper interest rate on their home loan. And they don't know what's available to them. They've got good borrowing capacity. They're sitting there. They might have a couple $100,000 worth of usable equity in their property. And we go through that process of going, this is the usable equity. The bank, currently that equity is sitting on the bank's books because the bank's got the title for the property, you've got the loan, and that's sitting as on their balance sheet. But what we're able to do is we're able to release that equity and we can use that to pay the deposit, the stamp duty, and also holding costs to hold that investment property. So a lot of the time, that investment property doesn't really cost them money out of their own pocket because we've set it up where it covers the deposit, the stamp duty and other costs, and also there's a buffer in there as well. So if there's a difference between the rent and the repayments, then that buffer gets used up. Then when they do their tax return, obviously they get a bit more money back from their tax return, put that back in there, and that helps service that facility that can be held for 5-10 years without them having to chip money out of their own pocket. So they can focus on paying down their owner-occupied debt, which is their non-tax deductible debt, and then they can have a tax deductible debt which is being maximised for their situation. And then whether they do 1, 2, 3, 4, 5 properties, my goal is to make sure every one of our clients has one investment property that they hold for the long term. Yeah. Because I know that in the future, then that property is going to increase in value. Yeah. And then whether they sell that and do a debt reduction on their owner occupied and pay their home off 10 years earlier, or they sell it in retirement and have a bit more buffer, or they keep it for forever and something to hand on to the kids.
Awesome. Look, and I think the and I talk about proactive and sort of where the property management side of things come in with the likes of both of yours. And it's really important for my business that I have that strategic relationship with both of your businesses, because ultimately, where a property management focused business sort of falls short in the industry is we are normally the last conversation. We normally, that you've gone through and you've had all of those long relationship building, trust building conversations with them, and then it comes to the settlement. We sort of step in the last 2 weeks where we go, oh, all of a sudden we need a property manager because it's an investment property. So as I think it's where I'm sort of leading to now. In a traditional real estate company, you would have your sales team be that front of house, so to speak. Whereas with our business, we are very, very strong in collaborating with the strategic partners like yourself, which is awesome.
Yeah, and I'd like to say that you as a property manager, you actually come into a lot of value in terms of after the relationship's done and they've held the investment property for a couple of years, and then whether interest rates have gone up or the market's got a little bit tougher or the tenants are moving out, you're the first person that they talk to about selling that property.
Yeah.
And that's a great opportunity for us to be, sit in front of that customer and go, okay, what's it really costing? And we can break it down into going, actually, we can structure it in a way, whether we chuck it on interest only, whether we, do a bit of a restructure, get some more cash, and so they don't have to hold that property, because if they buy an investment property and hold it for 2 or 3 years, they've gone through the whole process for no reason. They're selling it, they're not really making any money, they're cashing, they're really getting their cash back from what they've actually put into it. So the idea is to be able to hold that property long term, and to, when you can notice when that comes up, you're the first person having that discussion, and that's a great intro for us to be able to have that conversation, give them some ease, and really when things start to go get a little bit tougher, the immediate response is just sell the property, or the tenants aren't paying on time, or whatever it is that's happening that's giving them the stress, they end up wanting to just chuck the baby out with the bathwater.
Yeah, that's perfect, and you're 100% right. I sort of see our role in the strategic relationship between the three of us. We are that ongoing relationship. Where once a settlement has happened, our team at Proactive, we make sure that client, the landlord and tenant, they are good communication, effective communication, and also just educating them along the process. So that exactly what you said.
There's no doubt a couple of times, Charl, and even the managers work with interstate, is that speaking to the property manager, the clients have naturally, sometimes they just wake up one day and go, get nervous.
Yeah.
Right? And we've just got on the phone. The manager's actually called us and we've met the client and put their mind at ease and kept it. And same thing with you, like we do some cash flow stuff with them. Look, just rest. The market is turning. Here's some examples. Here's how it looks. Because people sometimes forget how the numbers really look. They see it at the time of purchase, and then they see all this money coming in, coming out, and you lose track.
Yeah.
Right? You think, how much is this property really costing me? And obviously that's where you come into vogue with what you do. We do the same thing on spreadsheets and PIA and this stuff to give clients comfort around this, and then they keep the property.
Yeah.
Right? And that's the best case scenario for every client involved, to keep then holding it over time, leverage that, build another one. The last thing you want to see is a client selling a property after a couple of years because of reasons that are really still within their control, if you can find another solution, which most of the time there is.
Yeah, and absolutely, I don't know knowing what you do, Hamish, to be able to buy a property that fits those metrics a lot better, rather than just walking into a property that they see, off the street or in their neighbourhood or their neighbour's house and going, I love this bay window, it's going to make a great investment property, where really it might not. And to be able to know those numbers beforehand, you're going to have better yields, you're going to have better tax deductions, and it's all going to be encompassed. So it just makes the client experience a lot better because they bought a better asset. It makes Chucky's job easy because you've got a property that's easily marketable to the market.
I think the stat is that most people, when they buy an investment without help, they buy within 10k where they live, because it's what they know. But majority of times, people's investments, they can't afford the areas where they live. The owner occupier is the one they put the cash into. The equity you're releasing, most of the time their borrowing capacity is substantially less, but they still want to buy where they live because it's what they can afford.
Yeah, I want to make sure that the tenants are mowing the lawn.
Yeah, correct. And I touch and feel it. So, but in the end, a lot of the time that isn't the right decision, because what you outlaid, is it the right yield? Is it the right growth? You've got heavy exposure in one pocket. Diversity is king. All these things you've got to explain to clients to be comfortable around it all, that you can it seems overwhelming to buy interstate. It seems overwhelming to buy in other areas. But in the end, if you simplify it for them, the process is actually quite simple. Right? It's quite comforting. But a lot of people don't see that until you can get in front of people like yourself and myself and our company to put their mind at rest.
Yeah, that's so true. And I think sort of what I'd like to sort of explore now is how would, with the two different industries that you're in, how do you see, and I'll lead on to sort of where the market is going and your trends and all of that type of stuff a little bit later on, but how your relationship with property managers, people like myself, like how does that fit in with your company structure as in having the conversation with those clients beforehand? Because I think it's a big thing that I'm really trying to work on at the moment is, as I said before, we normally get in right at the end because that's sort of traditionally the last step. But it's so vitally important on really getting in right in the beginning and answering that question, Hamish, where it is it a good yield? Is it a good area? So do you have, sort of explain to the listeners here on how you sort of have that conversations with someone in the early days on choosing that property management?
Well, for us, it's very important because the basis of buying an investment is all numbers, right? So obviously the time of acquisition, if it's an off-the-plan or an established property, we get appraisals of what the property is going to rent for, what the yield is. So we get figures from yourself or just the companies that we're involved with that give appraisals on the actual investment we're selling. So that figure is the most important because when we get to the point of handover or settlement, we need that figure in around the same point that it's been advised because that's what they're based their numbers off. This is their running costs. This is how they're living their life. To run this property, whether there's positive cash flow, negative gearing, whatever it is in regards to it. So it's incredibly important. The relationship's important. We want to get the property obviously leased out as soon as possible. Holding costs and empty properties no good for anyone in the industry. So it's a valuable part of our process. And you know how obviously early we get you involved in the process, especially with off the plan. We usually get you involved 6 to 8 weeks before settlement so that we make sure we're all in a row before that property is handed over to get that property leased out as soon as possible. So it's a critical component.
Yeah, and I think it's just to sort of add on to that, before we get into as a property management company, it's good that we get involved in the defect process as well, just so that we can be that post-settlement, communication with the builder. So what we tend to do is if we go in at defect, we try our best at that stage to really build that relationship with the builder and developer as well, just so that we can, because what you traditionally find with a lot of building companies is once settlement happens, they tend to move on to the next project, and then they have a maintenance department that sort of goes in and, they're quite busy. And they've got their money, so to speak, put in inverted commas, and then it's harder for them to deal with. But if we've got that relationship with them, that we're dealing with the foreman and we're dealing with the supervisors, it really just helps that maintenance go through.
Absolutely. It's one of the biggest, time-consuming and stresses of my job that is the handover process afterwards and the defecting. Because you're right, some developers are great, awesome, and they provide a great service and aftercare project for 6, 12, 18 months sometimes. But as you know, Charl, there can be some right at the other end that literally just want to wipe their hands with it, and it's incredibly difficult, right?
Yeah.
So, and all clients, they trust us, so I get heavily involved, and I don't want clients having properties where having issues with defects. So we always get it rectified, but there's no doubt a key property manager in this process helps alleviate our workload in this.
Yeah.
Because you can imagine there's quite a number of properties we're handing over on a monthly basis. To get across all of them is difficult. So having the support from yourself is obviously critical for our business.
Yeah, and I think it's, sorry, Jonathan, to interject. I think the importance part is, and what I've experienced with Hamish and One Haven is the ownership that you take with the clients moving in there. So you would go, and if the builder, we've experienced a few, developers and builders just recently where they just haven't stepped up to the mark. But I think what is important is the fact that you've gone above and beyond, and you've gone and said, look, we will cover those costs if need be, just to make sure that we get it right. So I think that works quite well, which is good.
Yeah, I think that because everyone lives in a house or a home or live somewhere, that everyone becomes an expert in property.
Yeah.
And what happens is that if you want to buy bread, you don't go and learn how to do bread and make bread yourself. You go to the baker who knows how to make bread.
Correct.
So it's important to have somebody like you guys in the corner. So if something does go wrong and those defects do come up, it just doesn't fall on deaf ears. It's always, they'll explain to you, the defects and bring up any questions that they have. And it's you guys going back to the developer and the builders to get those things rectified rather than on their own.
Yeah, and it's also knowing it's also probably knowing a bit about the defect, and it's knowing a bit about the issues at hand before, so that you can also give. Sometimes you can also give a client, like you said, we've dealt with some clients before in the past where we've gone, and their expectation is up there.
Yeah.
And we go back and say, look, it's where it stands, it's good, it's fine, it's operational, it's a rental property, it's not your personal home. We don't have to knock every wall down to fix a few scratches.
And the main thing with defects is a lot of people see a report and they're just frightened because the reports are always so big. But you actually look at the report, 99% of it's like a little lick of paint. It's all like a day's work that gets fixed. And it's very, very common with every builder and developer. But naturally, clients get naturally scared when you see this big list coming through and a little mark here, not a little smudge on the window here, and this sort of stuff. And then there's mortified. Or like, guys, just relax, it'll get fixed. It's a very, very easy fix. But again, you can imagine the maintenance, all of that is quite time consuming. Hence why the relationship with Charl and any property manager out there is so critically important.
Yeah, no, awesome. All right, moving forward now, I think the what I'd love, and John, I will probably start off with you, is just seeing the market trends and what's really been happening in that investment space over probably the last 18 months, and maybe give our listeners a little bit of insight of what you feel within Mortgage Choice and your industry, and what you feel like the next 18 months are going to look like.
Yeah, absolutely. So the last, I guess the last 18 months, even, post COVID, we've seen a lot of growth in, mostly the other states except for Melbourne. Melbourne's kind of been dormant for a long time. Whether
the exit stage.
Whether it's the elongated lockdowns or just sentiment. And I think sentiment is one of those things that it can turn on a dime. It can be everybody gets FOMO to everybody who doesn't want to do anything sitting on their hands. And I think that the rise in interest rate has really stemmed people down. If interest rates are going up, then they just expect interest rates to go up forever, really. But now that it's peaked and it's starting to come down, you're starting to see that sentiment in Melbourne really come back. I had an experience where I've got a client who bought an investment property up in Brisbane maybe 8 years ago, and he bought it for maybe 400 odd thousand. And every year, I think I spoke to him, every single year he would call me and he goes, mate, I want to sell this investment property. Okay, don't sell the investment property. Next year, I want to sell the investment property. Don't sell the investment property. And
Hamish's day to day.
Yeah.
I'm thinking in my head what this property's now worth and what
so,
I'm interested in.
So then he called me. He called me last year and he says, "Look, I've got an agent who says he can sell the property for 660,000. And I'm like, do not sell that property.
No.
Do not sell that property. You've got now the debt that you've got on is so small in relation to it. It's renting off its head, and even from last year, it's gone up another $50,000. And I said, don't sell that property. And he says, I knew you'd say that. And I'm like, but how long have we had this conversation for? And so sometimes it's just holding that client's hand through that whole process. And now, he's in a much better, he's in a great position. He's got equity in the property. He's looking to buy another investment property. So I think that what you're going to see in the next couple of, next 24 months, as interest rates go down, then property prices are going to increase. Every time the property market has increased, there's always been interest rate decrease. Yeah. So, that's what happens. It's happened before, and it'll happen again. You're starting to see it because more buyers are in the market because their borrowing capacity is increased. Yep. You get a bit more FOMO. We've still got an undersupply in Melbourne, as much as media might not say, but we have got an undersupply of housing. Definitely. We've got strong population growth, which is still coming in, and I'm sure you can talk to a little bit more. But I think that's it's probably a good time to own property in Melbourne at the moment.
Yeah, definitely. The amazing part is for all of the last 3 or 4 years in a rising interest rate market and cost of living is what's happened in the state. People have made substantial money. The markets have gone haywire. Brisbane's a great example. Perth, Adelaide, all these areas have seen double-digit growth consistently for 3 or 4 years. So an example, we sold some stuff in Brompton in South Australia 3 or 4 years, probably 3 years ago now. I remember selling them at sort of high 5s, and the 3-bed townhouses at high 6s. Now they're valued, the 3-bed townhouses at mid 9s. The 2-bed townhouses are over 800 grand. That's in 2 to 3 years. house land packages in Ripley, which is 30 to 40 minutes from the southeast Queensland. Brisbane CBD. Remember selling them at 500 to 550, now valued at 850.
Yeah.
And this has all been happening in the last 3 to 4 years in markets where supposedly rising interest rates turns people away. The main issue at hand has been Sydney and Melbourne. Sydney's been too expensive, affordability, and obviously Melbourne, we've all talked about, we all live here and we're aware of what we've been going through. So it's an interesting time given that's what's happened in that space, and now we're coming into a lowering interest rate market where naturally people's sentiment is more positive. Also then, I believe it opens up Sydney and Melbourne more because they've been the most conservative ones through all of this because they're the most impacted by COVID. So if rates start to come down further and then our biggest populated cities now go, hang on, I want to get a piece of this pie.
Yeah.
And they want to invest. All of a sudden, I think it's even going to be a more interesting time going forward where this growth cycle will continue interstate. And obviously Melbourne and Sydney will start to see a bit of this, fruit and start to see some really positive opportunities. Because I agree with the population. I agree with the supply. Our vacancy rates have been low for 3 to 4 years now. We've never seen them this low for this long.
Yeah.
Right, as a national level, and we aren't building enough homes. The government have announced a target of 1.2 million new homes over 5 years. They've gone on record. Depending on what data resource you look at, I saw one the other day, 460,000 homes behind target at the moment from that figure they've set for us. CoreLogic announced a report in the last 6 months, which we're trying to catch up, but we're still 25,000 homes behind that target.
Yeah, and they don't really have anyone to build them either.
No,
the commercial space for people in the building industry is much more lucrative than in the residential. So
correct.
It's easier for them to jump over into the commercial, get paid more. Why would they jump over into the resi?
Correct.
And if they do, then that just pushes the house prices up even higher.
Yeah.
So it's just the perfect storm. Like, we're not building enough supply, lowering interest rates, people's access to money, more people buying. It's just, I can't see how the property market slows down in any way. But the good news for Melburnians, if you're all listening in here, is I do believe Melbourne's now the most valued market in Australia, given, depending again which data resource you look at, we're the 6th or 7th most expensive city in Australia now. We've dropped from number 2 down to number 6 or 7, which is crazy, right?
Yeah.
So Adelaide's more expensive than Melbourne.
And our economy is bigger than New South. Melbourne economy is bigger than New South Wales.
So like, think about Adelaide. It's more. Like, Brisbane's so much more expensive than us now. I think their median price point was like 9.17. Melbourne's sub 8. Right?
So in
This stuff's not
terms,
making
and I
sense.
think this is good for the listeners to hear in terms, so when having that conversation now to a new client coming in, either from Melbourne or from Victoria or interstate, from what you're saying from the stats, you'll be pushing them into the Melbourne market?
Yeah, look, I still think interstate has growth to go. So I'm not saying no to those markets. I think it's just more to show where Melbourne's at.
Yeah.
It's the interesting piece. Like, it's always past performance is a great indicator of future performance, but there has been some big things happen in our government, in our state, that I think could have a big change going forward, like the land tax changes and everything. It's sort of definitely turned investors away from our market. So is that the new norm now?
Yeah.
Right? But you'd have to think we're at a point in time where it just becomes so cheap and affordable, the market just has to go one way. Like, everyone's attention will turn here because it's all they can afford as an investor between 600 to 800K. So definitely huge value within this market. But not saying no to some interstate opportunities. We still think there's some value, definitely. But if you're looking for your probably best bang for your bucket, that 600 to 700 grand now, there's no doubt Victoria represents a lot of value.
Well, folks, you've heard that here first. So if it does happen, click like.
Yeah.
Jono, on I think that's from a property perspective, from a banking, financial side of things in the property space. What do you are the banks really starting with the interest rate drops and all of that type of stuff? Are they really pushing to get investments back going again, or are they? Because I know sort of when I went through a few things, the banks are really hard to give out loans on that. Has that changed? What do you see happening in the future?
Yeah, like swings and roundabouts for the lenders. Sometimes lenders are in the market, then offering a lot of good pricing. Really easy to deal with. Sometimes they start to tighten the screws, and it's a little bit harder. So it's good that we've got such a wide range of lenders that we can choose from. So there's always somebody that's open to the scenario. But I think it's important to get the right structure for your individual circumstance. And I hear a lot of this, where people be at a barbecue and everyone's an expert there. They say, oh, you have to
Depends
have
on
an
what barbecue.
well, you have to have you have to have an offset account. But really, some people don't need an offset account, or some people go, oh, never cross-secure your properties, and some instances it does allow for cross-securitization and it makes it for a simple loan structure for those clients. So really making sure that you've got the tailored advice to fit with what you're trying to do. And it's not just going, okay, I want to do a refinance now for a cheaper interest rate, but in 6 months' time, I'm going to purchase an investment property. There's not much point doing it then. Let's just wait out until that time you're doing the investment property, do it at once, because you're going to have to pay extra fees, you're going to be jumping around, and it ends up being costing you more than what it is. So it's just looking at what's that whole scenario. And also, does it allow for what you want to do now? Does it allow for what you want to do in the future?
Yeah.
Because in the future, you could go, okay, I'm buying these 3 investment properties. I'm using the equity in my owner-occupied property, but I want to buy a new owner-occupied property in a couple of years. Okay, well, let's look at maybe bringing that forward and structuring it in a way so you can still do that. Because the last thing you want to do is buy 3 investment properties and then go to upgrade your owner-occupied property and realize that you can't do it.
Yeah.
And then you have to sell your investment properties, and then it goes through that whole process where, because you've held the investment properties for a short period of time, then you go, oh, property investment's no good.
Yeah.
Because I haven't seen any growth.
Yeah.
But in terms of the lenders, just making sure that it is tailored for the current situation that you have got. And this what comes into play if you're looking to buy an investment property and you're getting good rental yield. We need to know what that rental yield is for the lender as well. So a property that rents better, you're going to have better borrowing capacity. So
Cool. Look, so from a property management perspective, we have, we manage properties, and obviously properties have landlords, but properties also have tenants. So I think the next question I'd like to sort of throw out there to the table is, a lot of renters sort of rent a space because the area that they want to live in, to buy, and the mortgages, we spoke about that earlier, the affordability is just harder. They can probably get a nicer house renting than they would paying off a mortgage. So what advice would you go, if our tenants here listening, to this podcast would come to me and say, look, we want to get into the market, or we want to go, what would, from either side of your sort of approaches, what would you sort of say what would you want me as the property manager to say to that tenant, and how would how would they sort of get themselves started? Hamish, we'll start with you.
I think the best way to explain is actually talk to my mother on the way here. And I think it's an old school mentality that your mum and dad have ingrained you. You have to go and buy your own home to live in.
Yeah.
Right. But the world has shifted. Right. Not everyone has the luxury to go spend $1.6 million in Hawthorn. Right. If you're a first home buyer, you're young, you're 23, you want to live in Hawthorn and go out, do all the things you do as a 23-year-old. Right. So the mentality is, if I have a budget of $600K or $700K growing up, do I then go buy an apartment in Hawthorn? Then you look at it and go, is that actually, I'm just using that as an example, could be other suburbs. Is that the best growth asset at 24, 25, 30 years old at $600K to buy that in that area? Just because you want to live in it, but is it the best growth asset to where you want to get to? Unfortunately, in today's world, most of the time it's not, right? So if you want to buy within an area where you want to live, does your budget marry up to the right asset within that area? And most people just don't have that luxury.
Yeah.
Right. So the mentality of owning your own home needs to shift to the point, I believe, rent where you want to live, right? There's nothing wrong with renting as long as you've invested your money elsewhere to do something with it.
Yeah.
Right. And that's my mentality around it. So unless every younger generation now wants to go live in the outer regions and house land markets and regional, which they don't, let's start to use your money elsewhere to start create wealth, keep working your life, keep getting your employment, keep earning and creating your career and getting goals where you need to get to, and let the portfolio grow over value. And then eventually over time, of course, you can sell or whatever is, and get to the point where you buy the dream home in these areas you want to live. But you need to do something. You're better off doing something than nothing. Yeah. Right. And you need to really focus on where you want to live, and does your budget align with that? Yeah. In that area to actually create something of growth. If not, buy elsewhere. Yeah.
Perfect. Jono, what would you say?
And I love a good rent vesting story. I think it's really valuable, especially in those pockets of Sydney and Melbourne, where your property prices are so expensive, but the yield is so low. Yeah. So rent where you want to live, but also there's some great first home buyer benefits. I've got a client right now that they wanted to buy a $900,000 property. Yep. As first home buyers, but their timeline was a little bit further down the track. They go, maybe in the next 2 or 3 years we'll buy something for $900,000. And as a first home buyer, for $600,000, there's no stamp duty in Victoria. You can get the first home guarantee scheme where the government pays for the mortgage insurance. They say there's no stamp duty, government pays the mortgage insurance, and if it's a new property, at $10,000 first home buyer's grant. So they only need 5% plus costs. So on a $600,000 property, you're looking at like $33,000.
Yeah.
And they called me, they found a brand new property. So they're really looking at $23,000 out of their own money to buy this $600,000 investment property. I go and do that because you're only first home buyer once. Live in it. You need to live in it for 12 months.
Yeah.
Yep.
So live in it for 12 months and then go back to your rent vesting. Now you're in the property market. It's cost you next to nothing to get in there.
Good.
You know, they're like, oh, the property's a little bit further out than we want. I go, just do it. You know, like my sister did a similar thing during COVID when they were throwing out 25 grand home builders.
That was crazy. That was a crazy time.
No stamp duty. There was even a 25 grand rebate from a developer as well. So, and then $10,000 first home buyer. So there's great value into it to buy this property. And then interest rates went up and, you know, then she moved out, rented it out, stayed with family. And it's just it's a great story. Now there's a property that she didn't have before. She's actually Airbnb-ing it. And sometimes the rent for that one comes in at, you know, more than I'd get for a 3-bedroom place in Hawthorn. So it's crazy.
It's crazy.
And that's the mentality or the shift you have to have. You have to the time, you know, to go out to those areas. If they want to live out there but come back, it's a good example. He already said, he goes, oh, I don't really want to live that far out. So he had to do the time. Yeah. And now he's back where he wants to live. It's a mentality shift.
And I think that's really, and it's funny, and I'll sort of throw in that. So I've got a 15 and a 13-year-old, and, you know, with the way the kids are moving, they, you know, live in the family house till they're like 30. And I said to my son a couple of weeks ago, and I go, look, I'm happy for you to live with me till you're 30, but you would buy a new property every year. Yeah. You know, and you're using the money you're earning. And so I think, like I said, the shift, it's just, I don't think we have, you know, there is that whole sort of media scare out there that deposits are so high. But you've heard it first, you know, there are strategies out there. There are definitely opportunities. It's just making sure you speak to the right people, which is good.
I think the bank and mum and dad are going to be a critical one going forward too. Unfortunately for everyone out there listening, I think that the generational wealth is going to be so important for kids going through these days because the world is expensive, right? Most kids are going to need a leg up at some capacity from family help. Of course, there's hard workers out there, but I think the family support will be really important going forward.
No, and I heard something interesting that the largest owner of investment property as an age group are the younger generation. Yeah, we think the mums and dads are the ones that own property, but there's only a small portion of 8% of the population owning investment property, and a large portion of those are the younger people.
Yeah. Well, we see with our age demographic of client, like the from 27 or 25 to 35 coming through, most of them haven't owned a home. They're all buying investments. They're just happy renting. You know, we've got a couple up to their second and third properties now that literally just like they were kids, happy to rent. They like where they live. They go, I don't want to move. They just keep investing elsewhere. So, you know, if I told my mum that, I still rent now. I don't invest. I like Port Melbourne, but I wouldn't, you know, I think it's a great area, right? But I just invest elsewhere all around Australia and diversify the risk.
Yeah,
and if you need somewhere to stay rent free, then Chucky's place is always up for grabs.
as long as there's investments being bought. Now we're going to move on to, so that was more for the renters side of the listeners. Obviously, we've got our landlords as well, and we deal with a lot of sort of you know, younger landlords or different types of landlords, that obviously ones that really want to go out strong and invest into a lot of properties, or those that are sort of the mum and dad investors that, you know, it's ingrained, we need to have an investment. So they just go and buy, and it's a set and forget. They don't really talk about what advice would you go and give my portfolio of landlords that I've got now, where, you know, it's knowing what you know in your sort of areas of expertise, you know, is it good for them to come and have a chat to you guys to review their current situation? And, you know, would you guys sort of tell them to hold, or would you tell them to have a look at where it sits and what their next steps are in terms of their whole, not financial planning side of things, but like just from your perspective, would it be good for them to sort of review?
Yeah, absolutely. So investment loans typically don't get reviewed as much as what owner-occupied loans do, because they set and forget. They don't really care about it. And a thing that lenders do is they charge a loyalty tax. So the longer you've been with a lender that you haven't reviewed the loan, typically you're paying, I've seen clients that are over 7% now for their properties because the bank doesn't call up and say, hey, I've just dropped your interest rate down for no reason. And I rather the lower interest rates, the more money in the client's pocket, less in the bank's pocket, which is good tick for our clients.
Yeah.
So just having a look at it, and in some cases you don't even need to move lenders. It's just the case of a mortgage broker calling up the bank on behalf of the client and saying, hey, can you sharpen up this interest rate? Otherwise, we're going to move them somewhere else. And that might be enough to go, actually, here we go, we've dropped 1%, and 1% on a $500,000, that's $5,000 a year. It's a significant amount of money to, not pay the bank.
Yeah.
And Hamish, tell me, so once they've gone and reviewed, would it be advisable then to come and have a chat to you to see where they can best use that extra money?
Absolutely. I always say to any client, a conversation's free. Like, I'd be getting as much information as you possibly can, just to take in. So actually say that you're not too much, because sometimes you can be death by analysis, but definitely speak to people, finance, accounting, financial planners, like just to get an overall of where your position's at and what you can do. But on a property perspective, absolutely, come in and see what we're seeing, because I'm sure a lot of people in today's world on social media can get blindsided, I suppose, or by the amount of information on TikTok and Instagram and Facebook. Because if you're looking up property on your phone, and most likely your Facebook feed and Instagram and TikTok's full of all property gurus out there telling you what to do. Yeah. So definitely come through and just see the real information and what, of course, we've got our theories and ideas of what we think is right and wrong in the property market. So, get some advice and some ideas of what we think, and then maybe get some other external advice, and then you're going to make an informed decision off the back of that. So, but there's no doubt, I see some stuff online, you feel sick at some of the stuff that you see people promoting out there, because I guess the biggest thing you see is people promote so much about the now, what's valuable now. But like you've got it with property, it's so much around like where have we been for the last 30 to 40 years, where are we going to head? And it's a pretty consistent thing to look for property, right? What are the key measurements of growth? Right, stick with those things and you can make money, as you were talking about before, Charlie. You stick with those measures. But so many groups come and go, I'm going to try and strike on something now that's hot, right, which has no real data or statistical evidence behind it long term to show it's going to be a great long term investment.
So leading into that, and that's a really good point. So what would be your top 2 or 3 points you would go to our investment clients, our landlords and that? What would you say to them, this is what you need to look for before you come and have the conversation? Hamish?
Yeah, well, definitely just look at first of all, just look at your lifestyle. What do you want to do? Like, are you happy to slaving away at your own life, or do you want to get ahead and start to create some wealth? So the first port of call out of anything is always go speak to a financial professional. Like, budget's critical, right? So we'll always meet a client, but if they haven't got any of their budgets organised, it'll always be go back and see the broker, or go back and see the thing. And let's get your structure right. Where do you want to afford, right? That's the main port of call. Then obviously from there, the next point, get the right information, right? Get the right data, get the right correspondence to go, I feel comfortable about where we're heading, and get all the data. Yeah. What's not just happening locally, what's happening all around Australia to make.
So you're saying TikTok is not the source of information?
It can be sometimes, because some companies do provide some great information, whereas some not so much.
Yeah, okay. So be careful.
Be careful, right? And then sit down and just make an informed decision with the right people in your corner, right? And of course, that's finance, property, family. Yeah. Some family can be great support. Some family, not so much. Yeah. Right? I heard the Sunday barbecue talk before. That's been a real hard one in my job for 11 years, is the Sunday barbecue talk, because you provide the options to the client and they send it to a family member. And they come back with all these advice and all this research. And I always go, so where's this come from? Like, what's their opinion? And it goes, oh, no, just my uncle said it. Yeah. That's what I think.
Is that the uncle that knows everything?
And correct. He goes, oh, my uncle said it's not a good investment, good area. I go, cool, I respect
What does your uncle do?
Exactly. I respect his opinion, but what's the stats? Where's the data back there? He goes, oh, no, there's nothing. I think that's just a crap area. I'm like, okay, cool. Like that. Where's the evidence to support the decision you make?
Like Footscray or Redfern or
correct.
something.
Yeah. No, maybe Footscray or Frankston's a good example, right? So I'm always respectful of it, but family can sometimes be a great support, but sometimes it can be a massive hindrance. Yeah. Right? Because they're just usually most times their evidence or their decisions are based off just their own thoughts, not really based off stats.
Or old opinions.
Correct. Old opinions. Oh, go buy your own home, don't buy an investment. Why are you renting? Rent money, dead money. Yeah. Right? This stuff. So just getting enough information around you that's up to date in today's world to make the right decision and path forward for yourself.
Jono, would you agree with that?
Absolutely.
That's good. Excellent. Thanks for the insight. Right, folks. I think we've probably running out of time. Thank you so much for your time today. We're going to end this podcast. Obviously, we will be putting all the descriptions of both our wonderful guests in the descriptions below. But I'm going to really end off. I want 30, 40 seconds. Tell us really sort of end off today's day on how you sort of. And I think we talked about collaboration. That was the key point. So, and I really appreciate all the information that you've given, especially to my landlords and my tenants. And I thank you for your time. Really, it was amazing. To end off, Hamish from One Haven, what would your sort of call out be to the listeners?
I think it's just really have a think about where you want to get to in life around your investment journey, right? I remember when I was 20 and 18, I didn't know anything, right? From Warrawonga. I was too worried about just, drinking beer with my mate and coming down and playing football. So just have a think about where you want to get to. No one wants to work forever, right? Is it property? Is it finance? Is it shares? Whatever you want to do, like, nut at it early, because in the end, we don't want to work till we're 70. So, and then when you get to the point, have a think, come see the right people, right? Get the right people in your corner, whatever you do for a living, if you're a nurse or a doctor, that's your speciality, right? If I'm sick, I go see a doctor, right? If you want to create wealth, go see the right finance person, go see property to make the right decisions to make sure you're on the right path forward.
Perfect.
Right? That would be my advice.
Yeah, I was just going to echo that too.
Yeah.
Just having the right people in the corner that do what you want to do.
Yeah.
That do what, go and see that mortgage broker that's got a property portfolio. Otherwise they tell you to go and get into the property market, get investment properties, but they don't do it themselves.
Yeah.
So it's like, how much help can you be if you don't do it yourself? You haven't gone through the trenches. Also, if it sounds, too glamorous and too good to be true, it usually is. You got to do it slowly.
Yeah.
I had a client come and they're going to buy 10 properties in 10 years, and they're going to this crazy, structure that's not entirely legal to do, and to try and borrow more money than they can afford. But really, the bank's in the business of lending money. They make money by lending money.
Yeah.
And if you can't afford to pay it back, they don't want to lend you the money, and you probably don't want to borrow that money if you can't afford it, because it's just going to add more stress. So, get rich slowly, do it slowly, take it one step at a time, and that's going to really give you more fruits in the long term.
I'll just make one point on that one. I can't stress enough how important a really good mortgage broker is in your corner, because obviously we work with a lot of them around Australia business. We have a lot of referral partners, not only brokers, accountants and planners, and there's a broad range of experience. And I'll just stress to listeners out there that your broker is really important to people that understand not only about getting your best rate with the bank, but structural.
Yeah.
Structural advice on your loans is so important, because when you actually nut down and look at how in detail, it can cost you a lot of money if your structure isn't correct, if you go down the investment path or whatever it is you do. So having some of the experience is a huge advantage in this space.
And if you've got no savings and you need to get a personal loan for your deposit, it's probably not a good idea to buy an investment property.
Yeah.
Correct. You're probably a little bit about your means.
Now, just to sort of finish up, and I think, we talk a lot about who you listen, and who you get your information from. So just, again, for our listeners, in terms of, so Hamish, you are from One Haven Property Group. How many investment properties do you have personally?
At the moment, I've got 6.
6. We've got Jonathan from a Mortgage Choice Williamstown. Same question to you, sir.
So I've got 8. I've had to downsize a couple in the last couple of years due to rise in interest rates, but it's currently 8.
Yeah, and currently I've got 2 investment properties with 1 commercial, and so you've really just heard the information that you've got today, folks, is from people that play the game. They might be, and again, we talk about collaborations and we talk about how we are connected, but we really focus on the investment, and if you've heard it from 2 industry experts that are in the game themselves. Jonathan has, and I know Jonathan from a personal perspective, has had to play the game we all play. He's had to downsize slightly because of the economy and all of that type of stuff, but get your foot in the door. Folks, thank you so much for this time. Really appreciate the time you gave us today. And we will end off this podcast by saying thanks from the 2 beards and a bear.
Thank you.
Had to throw that in.
I'll get there eventually.
So thanks a lot. Feel free to leave any comments and tidbits or whatever, we'll respond to all of those and hope to talk to you guys soon.